we have on board Ujjwal Shah, Fund Manager and Chief Strategist, IIFL Securities, to help you understand the various tax-saving investments and deductions. So, Ujjwal, good evening and welcome to the show. You will be like a genie for a lot of our viewers who don't understand anything about tax savings, or maybe are usually confused around this time of the year when they have to start doing tax-saving investments. All right, so let's start with the old tax regime. We all know the kind of options or avenues available under the heads of ATC and ATCCD, etc. But which are the key tax saving instruments that you would want to highlight and start off with?
Sure. Thanks for having me in the show. And I do agree this is a busy period for everyone, looking around to save taxes. Like a wise man said, there are only two things certain in life. One is death and one is taxes. One we can plan for and one we can't. So it's better we plan for our taxes well in advance. Um, you know, uh, Given the uh, options that we all have in terms of saving taxes, I think right now, um, on the ATC side, I would rather prefer investing through mutual funds in the equity linked saving schemes, considering that other avenues like PPF and others are still earning like what 7.5% kind of returns, whereas ELSs would generally generate around 10 to 13% kind of returns depending on what levels we get in. And I think that on a longer period of time will help creating good wealth as well as help us save tax. We all know ATC helps in, the quantum is 1,50,000, and therefore investors, or rather people who want to save tax, can use this medium to save tax, possibly get an SIP done in this, which could help them out as well. So even in terms of tenure, a PPF has a tenure of 15 years or a lock-in period, we can say, whereas ELSS has a tenure of only 3 years, post which, if the need arises, an investor can also pull his money out. So on that side, I would prefer an ELSS. On the debt side, rather than investing directly into bonds or something, I would prefer uh, tax savers. Would rather look at investing through debt mutual funds, where they get indexation benefits. Uh, by indexation, I mean an investor, buys, say, at 100 rupees, the cost. Government provides, CPI, or inflation index, based on which every year the cost gets adjusted for the inflation. And thus, if an investor in debt mutual fund stays invested for a period of 3 years or more, can enjoy this indexation benefit, where on maturity, the indexed purchase price gets netted off, and therefore your cost, which increases with inflation, uh, gets adjusted. So your taxable income reduces to that extent, and you don't have to pay full taxes as compared to buying bonds directly. So I think on the bond side, uh, debt mutual funds could be a good instrument for investors. If anyone wants to save on the ATC side, I would rather opt for uh, ELSS schemes provided by mutual funds.
So, talking about senior citizens specifically, what are the options available under these heads? And we also have to talk about NPS.
Sure. So, for senior citizens, any which ways, government has given a lot of leeway in terms of the brackets that are involved. I don't suppose there are, for ELSS or for debt mutual fund that I just talked about, there are separate heads for it. I might have to get back and recheck on that. But I think government has rather given higher brackets to them for savings, and also in terms of medical insurance that senior citizens pay. They have a leeway in terms of gaining up to rupees 50,000 of the premium that they pay on their medical bills or medical insurance. They get that waived off in terms of their taxable income. On the NPS front, that's a very good point that you raised. This is an avenue, that has come up. It is basically a voluntary retirement savings scheme whereby people can invest systematically and plan for their retirement and get sustainable income out of it. Government has come up with a separate section, section 80 CCB slash 1B, where up to 50,000 rupees of investment, is allowed and in a financial year, and that amount you can save tax up to rupees 16,000 or something if you are on the top notch bracket of 30% plus.
All right. So now talking about your financial portfolio, it's very important for a person to align their financial goals in a way where you can also have tax saving investment instruments as a part of those goals. How can one go about it? Specifically talking about ELSS, because that's a category you have the benefit of equity in it. How can one actually start investing and aligning ELSS with your goals? Also, if you want to continue investing in ELSS for the second year, also after investing 1 year, do you get the benefit? The best way or the route to invest in ELSS, SIP or lump sum? How should one plan that?
Sure. So I think in terms of ELSS, every year you can invest up to 1,50,000 rupees. That is the allowed levels for Section 80C. ELSS typically, as the name suggests, are for tax saving purposes, and therefore all mutual fund houses, if you see their holdings as well, they take very safe bets in these schemes, and therefore it is aligned for all age groups, I believe. They do not go for very riskier bets, which a general mutual fund investing in a small cap or a mid cap might take, and therefore equity linked saving schemes or whichever schemes are running on this grounds from all the mutual fund houses are very safe bets for long term as well and for all age groups. Investors investing this year, next year, or year after, every year, whatever investments up to 1,50,000 gets adjusted on the Section 80C side. I would rather want to give some update on HNIs, because apart from the normal investors who are investing and doing this bit, HNIs who are getting taxed at very high levels of upwards of 40%, or anyone who is having equity investments as well in the markets. We are already seeing that a lot of people are now investing a lot in on the equity side, can use two or three uh, strategies to save tax from the markets as well. So, one strategy which I can talk about is on the tax loss harvesting. So, what happens is in a portfolio, I might have made 1,000 rupees of money as a short term gains in a financial year. I'm just throwing an example to you. But at the same time, I have certain stocks which have not performed well or which are making losses. On 31st March, if I book those losses, that loss gets adjusted against the profits that I made during a financial year. And on first, if I have faith on those stocks, I can buy those stocks back and have my portfolio as it was on 31st March. By doing this, against short term capital gain tax as well as long term capital gain tax, we can book losses, and only on the net amount you will be taxed during a given year's time. So, this is a tax loss harvesting which a lot of investors do at the end of a financial year. Also, there is something called as bonus stripping done by equity investors. So, what equity investors do is, if a company announces a bonus, they might buy into those shares, and on the X date, when the share gets adjusted for the bonus, they sell whatever holding they have in that company, because the price is adjusted for bonus already. You incur loss, notional loss, because you will get the bonus shares any which ways. That loss, as per tax laws, is allowed, and that gets adjusted against your long-term capital gains or short-term capital gains. So bonus stripping is something which is also very widely used by investors, and those who who are any which ways paying a very large tax or wants to save on their taxes on the equity side can use this two three parameters to save tax.
Last question to you. Let's talk about the new tax regime also. Now, this particular system discourages you also in a way to save money, which you could have done through the old tax regime. But then, if one wants to opt for a new tax regime, what are the kind of benefits you're missing on, and how different is it from the old tax system?
To be candid, I still would wish to stick to the old tax regime. I think we have a lot of avenues in the old tax regime where savings are possible. New tax regime is good for the government because all the hassle regarding all this sections and subsections where investors use a lot of these tools to save tax gets rid of. So I think it's more savvy to them rather than us. Although the percentages they have lowered it, but I think for individual investors there are still a lot of avenues in the old tax regime which I personally would want to use for ahead.
With that, thank you so much, Ujjwal, for being a part of this
Thank
show
you.
and helping our viewers.